This is a withdrawal receipt, dated January 27, 2026, printed at an ATM in Frankfurt, Germany, at 3:42 in the afternoon. The transaction requested was €2,000. The transaction completed was €300. At the bottom, in small text that most people never read, 4 words. Daily limit temporarily adjusted. Temporarily. That word is doing a lot of work. Across 17 European Union member states, ATM withdrawal limits were reduced by 60 to 85% over a 72-hour period ending yesterday. No press conference. No coordinated announcement. Just quiet instructions sent from central banking authorities to commercial banks, who then pushed software updates to their ATM networks between 2 and 4 a.m. local time, when transaction volume is lowest and public attention is elsewhere. If you live in Europe and tried to withdraw cash this week, you discovered a new reality. The money you thought you had isn't quite as accessible as you believed. The account balance on your screen represents a claim, the cash in your hand represents settlement, and the gap between those two things just became visible to 340 million people. This is not a glitch, this is a policy. Here's what they're not telling you. At 11:15 p.m. Central European Time on January 24th, the European Central Bank activated a mechanism that hasn't been used since the Greek debt crisis of 2015. It's called the Emergency Liquidity Assistance Protocol, ELA, and it allows the ECB to provide emergency funding to national central banks whose domestic banking systems face acute liquidity stress. The ELA activation was not disclosed publicly. It was reported in a single line item buried in the ECB's weekly financial statement, published with a 3-day delay, under the category Other Claims on Euro Area Credit Institutions. The figure, €247 billion. To put that number in perspective, the entire Greek ELA operation at its peak, the one that made global headlines and nearly broke the Eurozone, totaled €89 billion. What happened last Friday represents nearly 3 times that amount, distributed across a banking system 7 times larger. The official story, when journalists finally noticed and asked questions, was precautionary liquidity provision in response to seasonal deposit fluctuations. January, they explained, always sees elevated cash demand, post-holiday spending patterns, tax payment preparation, nothing unusual. But seasonal fluctuations don't require activating emergency protocols at 11:15 p.m. on a Friday. Seasonal fluctuations don't trigger simultaneous ATM limit reductions across 17 countries. And seasonal fluctuations don't explain why the ECB's overnight lending facility saw €134 billion in borrowing on Monday morning, the highest single-day usage in the facility's history. Something broke, and the emergency response tells you exactly how serious the break was. The mechanism is straightforward once you understand how European banking actually works. Commercial banks in the Eurozone operate on what's called a fractional reserve basis. They hold a small percentage of deposits as actual cash or central bank reserves and lend out the rest. The current average reserve ratio across major European banks is approximately 1.4%. For every €100 you deposit, your bank keeps €1.40 on hand. The other €98.60 is lent to someone else, invested in securities, or used to cover the bank's own obligations. This system functions perfectly as long as depositors don't all want their money at the same time. It functions perfectly as long as confidence remains intact. The moment depositors begin to doubt, the moment they start preferring cash in hand over digits on screen, the mathematics become impossible. What happened last week was not a bank run in the traditional sense. There were no lines around the block, no television cameras capturing panicked crowds. Instead, there was a quiet, distributed, digitally mediated increase in cash withdrawal requests that exceeded the system's ability to fulfill them. The data tells the story. ATM withdrawals across the Eurozone averaged €2.1 billion per day in December 2025. In the first 3 weeks of January 2026, that figure rose to €2.4 billion, elevated but manageable. Then, between January 22nd and January 25th, daily withdrawals spiked to €4.7 billion. The system's cash distribution infrastructure, the armored trucks, the vault inventories, the ATM restocking schedules, is designed for €2.5 billion in daily demand. It cannot physically handle €4.7 billion. The ATM limits weren't imposed to punish depositors. They were imposed because the cash doesn't exist in sufficient quantities to meet the demand. This is where the lie becomes unsustainable. The European banking system holds approximately €9.2 trillion in household deposits. Against this, the physical euro cash in circulation, every note and coin in existence, totals 1.57 trillion euros. But that 1.57 trillion euros isn't sitting in bank vaults. It's distributed across the entire economy, in wallets, cash registers, home safes, and shadow economy transactions that never touch the banking system. The actual cash available within the banking system for withdrawal, vault cash plus ATM inventory, plus central bank reserves, amounts to roughly 420 billion euros, against 9.2 trillion euros in deposit claims. The ratio is 22 to 1. 22 euros of claims for every 1 euro of cash. This ratio is not a secret. It's not a conspiracy. It's the fundamental architecture of modern banking, visible in any central bank statistical release. But most people never do the math. Most people assume that my money in the bank and money I can withdraw are the same thing. Last week, millions of Europeans discovered they are not. The paper versus physical distinction applies to currency itself, not just precious metals. A euro in your bank account is a paper claim, a promise by your bank to pay you on demand. A euro note in your hand is physical settlement, the obligation discharged. In normal times, the distinction is meaningless. You can convert one to the other freely, instantly, without thinking. But we are no longer in normal times. The divergence between digital euros and physical euros now has a price. In Athens, informal currency exchangers, the same networks that operated during the 2015 capital controls, are offering 94 euros in bank transfer for every 100 euros in physical cash. In Rome, the premium for cash is 4%. In Berlin, it's 2.3%. These are small numbers in absolute terms, but their existence reveals something profound. The market is beginning to price the difference between a banking system promise and actual money in hand. When institutions do what they're doing now, they're not managing risk, they're containing disaster. The ECB's emergency response has 3 visible components, each one a signal of escalating concern. First, the ELA activation itself. Emergency liquidity assistance is not a routine tool. It exists specifically for crisis conditions, when normal monetary operations are insufficient. Using it for seasonal fluctuations is like calling the fire department because your kitchen is slightly warm. Second, the coordinated ATM limits. 17 countries implemented nearly identical restrictions within a 72-hour window. This requires planning, communication, and agreement at the highest levels of European financial governance. It does not happen by accident, and it does not happen for minor operational issues. Third, and this is the detail that institutional observers are watching most closely, the ECB quietly suspended mark-to-market accounting requirements for sovereign debt holdings on January 25th. This technical change allows European banks to continue valuing their government bond portfolios at purchase price rather than current market price. Why does this matter? Because European banks hold approximately 2.8 trillion euros in Eurozone government bonds. When interest rates rise, bond prices fall. The current market value of these holdings is roughly 340 billion euros below their book value. Under normal accounting rules, this 340 billion euro loss would need to be recognized, devastating bank capital ratios, and triggering mandatory recapitalization requirements. The accounting suspension allows banks to pretend the losses don't exist. It is, in essence, permission to lie on their balance sheets. This is not a policy designed for a healthy banking system experiencing minor seasonal stress. This is a policy designed for a banking system teetering on the edge of cascading insolvency. Less than 96 hours remain before the next critical threshold. On January 31st, European banks must submit their quarterly liquidity coverage ratio reports to the ECB. These reports measure each bank's ability to survive a 30-day stress scenario, essentially, their capacity to withstand the kind of deposit outflows that occurred last week. The previous quarter's reports, filed in October, showed the Eurozone banking system comfortably above the required 100% threshold, with an aggregate LCR of 164%. But those calculations were based on pre-January deposit behavior. They assumed normal withdrawal patterns, stable funding markets, and no emergency protocol activations. The January 31st filings will tell a very different story. Banks that appeared well capitalized 90 days ago may now be below regulatory minimums. And when those numbers become public, as they must under EU transparency requirements, the depositors who were already nervous will have documentary evidence that their nervousness was justified. The feedback loop is already spinning. Concern leads to withdrawals. Withdrawals strain liquidity. Strained liquidity triggers emergency measures. Emergency measures confirm that concern was warranted. Confirmed concern leads to more withdrawals. While one side restricts, the other side accumulates. On January 23rd, the same day European ATM limits began their quiet descent, the People's Bank of China announced the settlement of a 14.7 billion euro currency swap with the Russian central bank. The transaction, conducted entirely outside Western financial infrastructure, exchanged yuan for rubles at an exchange rate determined by the Shanghai benchmark. The significance lies not in the amount, but in the denomination. For the first time, a major bilateral swap between China and Russia was denominated in euros rather than dollars or yuan. Both nations are actively acquiring euro-denominated assets, not through European banks, but through direct sovereign-to-sovereign arrangements that bypass the Eurozone's commercial banking system entirely. They are accumulating claims on European assets, while European citizens are being prevented from withdrawing their own money. The Shanghai Gold Exchange reported a 47% increase in euro-settled gold purchases during the week of January 20th to 24th. Russian sovereign wealth funds, according to Moscow financial disclosures, converted approximately 8 billion euros from European bond holdings into physical gold stored in Russian vaults during the same period. The gold flows from west to east. The euros flow from private European hands into state-controlled Eastern balance sheets. This is not about currency preference. This is about settlement risk. Eastern institutions are looking at the European banking system and making a calculation. The paper claims may not be honored when the moment of truth arrives. Better to convert those claims into something that cannot be frozen, limited, or digitally controlled. The BRICS nations collectively hold approximately 890 billion euros in Eurozone exposure, government bonds, corporate debt, and bank deposits. In September 2025, that figure was 1.1 trillion euros. The reduction of 210 billion euros in 4 months represents the largest coordinated withdrawal from European financial assets since the 2011 sovereign debt crisis. But this time, the withdrawn funds aren't being redeployed into dollars. They're being converted into gold, yuan-denominated securities, and direct commodity stockpiles. The flight from Europe is simultaneously a flight from the Western financial architecture itself. This is what a system looks like when it runs out of time. The European Central Bank faces a trap with no exit. Deposit outflows require cash provision. Cash provision requires either printing physical currency, which takes months and stokes inflation fears, or restricting withdrawals, which confirms the crisis and accelerates outflows. Raising interest rates to attract deposits back into the banking system would crater the bond market, crystallizing the 340 billion euros in hidden losses and triggering the capital crisis the accounting suspension was designed to prevent. Lowering rates to support bond prices would accelerate deposit flight into cash and alternative assets. Every door leads to the same room. The mathematics accumulated over 15 years of zero-rate policy, quantitative easing, and balance sheet expansion have finally converged into a corridor with no branches. The European banking system currently holds 31 trillion euros in total assets against 1.9 trillion euros in tangible equity capital, a leverage ratio of 16-1. At this leverage, a 6% decline in asset values wipes out the entire equity base. The hidden bond losses alone represent a 5.8% impairment. The system is not approaching insolvency. It is being prevented from recognizing the insolvency that already exists. The historical parallel is precise. In September 2008, the United States faced a banking crisis that had been building for years, but became visible in a single week. The policy response was emergency liquidity injection, accounting forbearance, and coordinated government communication designed to prevent panic. The measures bought time, months, eventually years, but they did not solve the underlying mathematics. They simply transferred the losses from private balance sheets to public ones, from banks to taxpayers, from the present to the future. Europe is now executing the same playbook 15 years later, with a banking system 3 times more leveraged and a sovereign debt burden twice as large. The policy tools are identical, the vocabulary is identical, the promises are identical. What differs is the global context. In 2008, China held $1.9 trillion in foreign exchange reserves and was actively purchasing Western financial assets. Today, China holds $3.2 trillion in reserves and is actively divesting from Western exposure. In 2008, the BRICS nations were fragmented emerging markets with no coordinated financial infrastructure. Today, they operate an alternative payment system processing $2.8 trillion in annual trade settlement outside SWIFT. The lifeline that pulled America back from the brink in 2008, global confidence in Western financial architecture, is no longer available to Europe in 2026. The rest of the world is not buying the dip. They are heading for the exits. The question is not whether the European banking system will be restructured. That is now mathematically certain. The question is who bears the losses. Under normal bankruptcy proceedings, losses flow in a specific order. Shareholders first, then bondholders, then depositors above the insurance threshold, then insured depositors, then taxpayers. The entire apparatus of emergency measures currently being deployed is designed to prevent this waterfall from activating, because once it starts, the contagion is impossible to contain. But preventing the waterfall requires maintaining the fiction that the water isn't rising, and every ATM limit, every accounting suspension, every midnight liquidity injection makes the fiction harder to sustain. Those who have studied previous currency crises recognize the pattern. Argentina 2001, Cyprus 2013, Greece 2015. The sequence is consistent. First, quiet restrictions appear. Then, official denials that anything is wrong. Then, broader restrictions presented as temporary. Then, the temporary becomes permanent. Then the conversion, deposits forcibly exchanged for government bonds, or devalued currency, or simply frozen indefinitely. The €100,000 deposit insurance guarantee, Europe's promise that small savers are protected, depends on the solvency of the insurance fund. The Single Resolution Fund currently holds €78 billion. Total insured deposits across the Eurozone exceed €6.3 trillion. The ratio is 1.2%. If even 2% of insured deposits required payout, the fund would be exhausted in weeks. The guarantee is not a guarantee. It is a promise backed by the same government balance sheets that are already guaranteeing the bank assets that are already underwater. The informed are not panicking. They are moving, quietly, systematically, and quickly. Since January 15th, physical gold purchases at European dealers have increased 280% compared to December averages. Premium over spot for immediate delivery has widened from €12 to €67 per ounce in 10 days. Allocated storage requests at Swiss vault facilities have overwhelmed capacity, with new clients being quoted April availability for accounts requested today. Bitcoin transfers from European exchanges to self-custody wallets spiked 340% in the 72 hours following the ATM limit implementation. Not trading, transferring. Moving digital assets from platforms that could be frozen to private keys that cannot be. Wire transfers from European banks to non-EU jurisdictions increased 47% in the week ending January 26th, according to SWIFT network data. The primary destinations: Singapore, Dubai, and the Cayman Islands. The primary demographic: accounts with balances between €250,000 and €2 million. Not the mega-wealthy, who moved years ago. The merely affluent, who waited until the evidence became undeniable. These are not investment recommendations. These are observations about what is already happening while the official narrative insists everything is fine. The divergence between the official story and observable reality has never been wider. Governments say the banking system is sound while activating emergency protocols. Banks say deposits are safe while restricting access to them. Regulators say accounting rules are being optimized while suspending the requirement to report actual losses. The gap between words and actions is the gap between paper and physical. The words are claims, the actions are settlement, and right now the actions are telling a very different story than the words. Reality does not require permission to assert itself. The mathematics of European banking, the leverage, the hidden losses, the deposit-to-cash ratio, the sovereign debt spiral, existed before last week. They will exist next week. The crisis did not begin on January 24th. It simply became visible. What changed is the public's awareness that the claims they hold may not be honored in full. That awareness, once created, cannot be reversed by policy announcements or temporary measures. The doubt has been planted. The withdrawals have begun. The feedback loop is active. The only question now is speed. How quickly does doubt compound? How long can restrictions contain outflows before they accelerate them? How many more temporary adjustments before the temporary becomes the new permanent? The clock is not measured in months. It is measured in weeks. Somewhere in Europe tonight, a family is looking at an ATM receipt showing a €300 withdrawal against a €2,000 request. They are doing arithmetic that was unnecessary 6 months ago. They are making calculations that would have seemed paranoid a year ago. And they are reaching conclusions that, once reached, cannot be unreached. The banking system did not shut down completely. That would be too obvious, too sudden, too impossible to deny. Instead, it partially closed, just enough to reveal the truth while maintaining the pretense of normality. But partial closure is still closure. A door that opens only 15% of the way is, for practical purposes, a door that is mostly shut. Europe just shut down its banking system. Not with an announcement, not with a decree, with 1,000 quiet software updates pushed at 3 a.m., each one saying the same thing in different languages. The money you thought was yours is not quite as yours as you believed. Now everyone gets to decide what to do with that knowledge. The window for decision is open. It will not remain open indefinitely.